Hello, I'm Curtis Chambers with the Chambers Financial Group located in Largo, Florida. Today I would like to talk about tax planning. Tax planning is an important part of the financial planning process. I find, however, that often we approach tax planning from a standpoint of how was the tax return this year? Was it more or less perhaps than was anticipated, and if it's less, that's good. If it's more, that's not good. A more helpful way and useful way to approach tax planning is as a process, a long-term process that really begins when we start saving for retirement and then continues as distributions are taken during retirement and ultimately culminates when transferring assets to beneficiaries and charities. We have recently introduced at our firm new tax planning software, and this powerful analytical software can interpret a tax return very quickly based on a 1040, and it will collate the information and give us insights on that tax situation. We can also use the software in real time to analyze different scenarios that will give us feedback on what different tax planning strategies might produce. I would encourage you to schedule your tax planning review today with us. So here's a few tax planning ideas, and the idea, kind of a look at what we might find. For people who are retired, one common strategy is tax loss harvesting. And tax loss harvesting is where assets that have a loss based on cost basis are sold and repositioned in order to realize that tax loss. And the tax loss can then be netted out against capital gains or carried over into the future indefinitely. Another strategy we use for retirees is what I would call mini Roth conversions. And this is where there are disadvantages to Roth conversions and advantages. The disadvantage to a Roth conversion is that all the taxes are owed immediately up front. So it brings the taxes forward. So one strategy are mini conversions, where when someone is in a lower tax bracket, we'll convert just a small amount each year, enough to fill up the bracket but not push into the higher bracket. But over time, we can produce a pretty good amount into Roths this way. What about for people who are working and saving for retirement? Well, here the key is to utilize qualified plans. Utilize the 401k. The 401k is the 800-pound gorilla of retirement savings. Congress outdid themselves when they developed it. It's one of the best wealth-building tools ever invented if used properly. So take advantage of your 401k. If you don't have access to a 401k, then be sure to utilize a Roth IRA or a traditional IRA. If you're self-employed and don't have a qualified plan in place, take a look at putting one in. You may consider a SEP, a simple, or an owner 401k. What about gifting to charity? Well, one thing when gifting to charity to remember is to gift appreciated assets if possible. So imagine someone has a stock that they bought 30 years ago and it's gone up in value, and they sell it and give it to charity. They would pay taxes on all the capital gains from that stock. But if instead they gifted the stock itself to charity, the appreciated stock itself to charity, they would not owe those capital gains, but they would still get the charitable deduction. Another strategy to take advantage of is QCDs, or qualified charitable distributions. If someone is 70.5 and they have an IRA, they can give their RMD directly to a charity, and they are not taxed on that RMD. And we're finding in our tax planning reviews that many who are eligible for this strategy are not utilizing it. So I would encourage you to schedule a tax planning review today, whether you are retired or planning for retirement or giving to charity. It's of course also an important part of putting together an estate plan. You can reach us at chambersfinancialgroup.com or call us directly at 727-216-6280. Financial planning and tax planning are easier when you're not going it alone. The right partner makes a difference.